Greetings, Adam Hires here. Hires and Associates Insurance. We're an independent brokerage working across the United States, and we specialize in long-term care. And today we're going to talk a little bit about long-term care hybrid annuities. So let's get right into it and talk a little bit about long-term care annuity basics here. Most hybrid long-term care annuities are built on a fixed annuity platform. Fixed annuities, if you have not seen these before, are safe and insured products. They work a lot like CDs do at the bank, but you just get them from insurance companies. They have a declared rate, very dependable and reliable. So there's a little bit of underwriting, but if you're accepted into one of these products, your deposits are leveraged 2 to 3 times over. So if you're in very good health, you give $100,000 to the insurance company, it's going to be leveraged 3 times over, and they're going to give you $300,000 back that can be used for long-term care. Only non-qualified funds, those are post-tax funds are accepted into these products. So that's going to be like money you have in the bank, checking account, CD, maybe a non-qualified annuity. Talk a little bit more about that. But they don't take IRA dollars, 403Bs, things like that. We can convert those funds, but it has to be post-tax for these accounts to work. Joint and single policies are available, so if you're married or with a spouse, you can add your spouse to your policy to increase your leverage and the ability to use these policies all at once. And a lot of folks ask about the leftover funds, and leftover funds, if there's any in the annuity that hasn't been used for long-term care, they're just going to go back to your beneficiaries. So we'll look at a couple illustrations here that explain all of that, but those are the basics. A lot of folks ask about annuity growth and inflation protection. All fixed annuities grow yearly based on the declared rate. Interest rates aren't very high right now, so we have to keep that in mind. These aren't growing by 3 or 4% as of the making of this presentation here. And one of the reasons that these annuities don't grow as quickly is there's also an annual cost for the long-term care. So you have to think about it from the insurance company's perspective. They're giving you $300,000 back, so they're leveraging this money over. So this product's not going to grow by 3, 4, 5%, maybe 1 or 2%, because some of those percentage points are being used to pay for the long-term care rider, to pay for that extra $200,000 they just gave you. However, inflation protection can be purchased on these products. They can leverage your money over and your benefits over. Show growth of 3, 4, or maybe 5% depending on the product with the company that you purchase and invest in. And so that's wise if you are in your 50s, 60s looking at something like this and want to ensure that your long-term care benefits are going to grow just like they might grow with, say, a more traditional plan where you just pay yearly. So people like that you've got that guaranteed annual growth with inflation protection if the annuity itself is not as growing as quickly as we might like. Taxes. Taxes are very important when it comes to all long-term care. Now, we already know that non-qualified annuities grow tax deferred. If you don't pull your money out of a long-term care annuity, it can stay in there tax deferred for as long as you want. However, the IRS labels hybrid annuities as tax qualified policies. That's a good thing. That's what we want. All long-term care is tax qualified, at least the kind of long-term care you might consider. And so it means a couple of things when we talk about tax qualified. First, that it means you can use these policies, the benefits, just about anywhere long-term care might be needed or accepted. So that would be a nursing home, an assisted living facility, at your own home, hospice, any number of places. But it also means the funds that you use that come out of the policy are tax-free. So, you put $100,000 in, it's grown to $300,000 or $350,000 with inflation protection or annuity growth. Any of that extra money that you're pulling out, you do not have to pay taxes on. Well, that's one of the reasons why we can only put post-tax money in there, but the growth comes out tax-free when you're paying for long-term care expenses in any setting. This also includes deposits from an existing non-qualified annuity. So a lot of people have non-qualified annuities for the last 5 or 10 years. They have a lot of deferred income built up in there. They can take that money and put it into a hybrid annuity. So let's say they have $100,000 they invested 10 years ago, grew to $150,000. They could do what's called a 1035 tax-free exchange. Take all of that money, the $150,000, put it into a long-term care annuity, get $450,000, and then that could be taken out if needed, for long-term care tax-free. So that's a very nice feature if you've got some existing non-qualified annuities. A lot of people also ask about underwriting. Most applicants are accepted. One reason that hybrid annuities are very popular is that about 80% of all folks are accepted at either 2 or 3 times over the benefits and the amounts that they put in. Put in 100,000, get 200,000 or 300,000. Most folks are accepted. That's different than traditional long-term care that you see out there, where they're very picky about who they take and what kind of benefits they're going to give you or what kind of ratings. Sometimes they just price you out of those plans and make them much more costly than what you applied for. So these annuities are a little bit easier to qualify for, but you're getting all the normal benefits that you would with a traditional policy, except it just requires that you put more money in at once. But that's a good thing. When you're putting money into one of these, maybe it's 100,000 one time lump sum and you're done with it. Never have to put any money in ever again. So that's different than traditional long-term care. You don't need a physical to apply. Most of the times they might just do a phone interview. They might check your medical records, but you don't have to go see your doctor or anything unusual like that. And then benefits can begin almost immediately, depending on how you've got your product set up. Now, some people have a 90-day wait, but if you have purchased one of these products and 6 months later, all of a sudden your health changed dramatically, these policies can begin at that time, which is a nice feature. So it's not as if you need to wait 1 or 2 or 3 years for the benefits to begin if you need them sooner than anticipated. So again, Hires and Associates here. We're long-term care specialists. You can find us on the web at ohioinsureplan.com. But without further ado, let's take a little bit of a look here at some illustrations. So let's take a look at a popular product out here, Global Atlantic 4-Care Fixed Annuity. And let's just use an example of a 60-year-old male. Put in 100,000, no bells or whistles. Now with this particular product, it's 3 times leverage over, so you put 100,000 in, and you're going to get $300,000 in long-term care benefit right away. So here's our 100,000 that we've put in. Here's our total long-term care benefit of 300,000, and what that ensures is a monthly benefit for long-term care expenses of $4,231 for 60 months. So this particular product is going to pay out for 60 months, so 5 years. So that is a nice benefit there. Now this assumes no growth here whatsoever. This assumes very low interest rates, and it assumes that the policy is not getting enough interest to do anything other than pay for the long-term care rider. But if we go a little bit further down here, we can see that there's some non-guaranteed benefits. So if interest rates are cooperating, put our 100,000 in, it gets leveraged over to 300,000, and that 300,000 grows each year, and then so does the monthly maximum benefit. So this means, let's say you don't use your policy for 10 years. 10 years from now, the long-term care benefit pool is $350,000 approximately, and it's going to pay out $4,859 a month for a minimum of 60 months. If you don't use all your benefits, then it can last even longer than that. If you don't use any of your benefits, then you've got a death benefit. This shows our death benefit right here of $116,000. After 10 years, that's what would go to your family if you didn't use this policy at all. So that's quite a bit different than traditional long-term care. So that's a basic overview, no inflation protection, anything like that, just basic growth in the annuity, assuming interest rates are cooperating. Here is another example, and I won't do but 2 of these just because everybody's situation is a little bit different. This shows a male and a female, both 60 years old, and by a joint policy. They put in $200,000, but they did this a little bit differently. They put inflation protection on this product, 5% compounding inflation protection. So the 200,000 goes in, but you see a pretty large rider charge right here. That's what the inflation protection costs. So that's money that you're not necessarily going to get back, but it assures that the policy is going to grow each year, and we like that, and we use that with our younger clients. But it is an expensive rider, so you want to keep that in mind. But just to give you an example, we've got about 120,000 in here that's leveraged over 3 times. That gives us about a $360,000 benefit, and a pool of money that would last for 7.5 years. So the joint policy lasts longer than the single policy. It lasts 7.5 years with this particular product, this particular company. But then you can see each year that it's growing. The inflation protection is kicking in. So this isn't even annuity growth. This is the inflation protection. So if they don't use this policy, let's say for 15 years, all of a sudden it is an $8,000 monthly benefit that they could both draw at the same time. But just keep in mind, if they're both drawing it at the same time, the policy wouldn't last 7.5 years. It would last half as long. So maybe one spouse is using 3,000, one spouse is using 5,000. A lot of different ways this can be used. One spouse is using all 8,000. It just kind of depends how you want to do it. But both can draw out, again, 8,000 a month at the same time if both happen to be using long-term care benefits. So quite a bit to consider here. Again, these are just two illustrations. Wanted to give you a basic example. If you'd like to, just call us. We're Hires and Associates here on the web. We do a lot of different long-term care, traditional hybrid life plans, hybrid annuity plans, short-term, long-term care, and many types of others. And you can just go on here, go down to long-term care, request some quotes, and we'll be here to help you and show you some illustrations that are going to be more applicable to you. So we hope you found this informative. Again, contact us with any questions and we'll be happy to help. Thank you for viewing our presentation.